Starting off with risk-adjusted WACC. This is the next chapter that we are looking into. And when do we use that? When a new project's business risk differs from the company's existing risk. So this is the company and this is the new project that they're doing. So the risk of this particular company and the risk of this particular project are not the same, right? Are not the same. If it were the same, we could have used the WACC of the company only. If it were the same, we could have used the WACC of the company to discount the cash flows. But since it's not the same, what we have to do, we have to adjust the existing WACC of the company. We have to adjust the WACC a little bit. And this adjusted WACC is what we can use as a discount rate. This adjusted WACC is what we can use it as a discount rate to discount the cash flows, right? The adjusted WACC is what we can use as a discount rate to discount the cash flows. So that is the topic of this particular chapter, that there is the company and then there is a project. The risk of the company and the risk of the project are not the same. The risk of the company and the risk of the project. The risk of the company and the risk of the project are not the same, right? They are not the same. So what we have to do, we take the WACC of the company, we adjust it to reflect the risk of this project, and that is called a risk-adjusted WACC. That is called risk-adjusted WACC. Okay, that is called risk-adjusted WACC, and that's pretty much what we are looking to study here. If the new project's business risk differs from the company's existing risk, or if the project changes the capital structure of the company, the existing WACC cannot be used. So one is this case. Second, the new project, it changes the capital structure of the company. Right? The capital structure of the company changes. Two instances. One we saw when the risk is not the same. Second, the new project changes the capital structure of the company. In both the cases, we cannot use WACC. In both the cases, we cannot use WACC. What do we have to use? Risk-adjusted WACC. Right? We cannot use WACC. What do we have to use? Risk-adjusted WACC. Okay, we cannot use WACC, but what we have to use? Risk-adjusted WACC. Okay, so they are the two instances when we use risk-adjusted WACC. Yeah. If the new project's risk differs from the company's existing risk, or if the project changes the company's capital structure, so the existing WACC is no longer an appropriate discount rate, right? The existing WACC is no longer an appropriate discount rate. What do? We calculate a risk-adjusted WACC, right? Or an APV method is used. So what do? As a solution, we use a risk-adjusted WACC or we use an APV method. Either the risk-adjusted WACC is used or we use something called as a APV method in these two situations. Okay, so these are the two situations when we use the risk-adjusted WACC or we use the APV method. Okay, moving forward now. This is a visual overview of this particular chapter. What are we really studying in this particular chapter? Is the top topic is investment appraisal. Under that, we will study number one, risk-adjusted WACC, number two, APV. These are the two things we'll study, and risk-adjusted WACC, there are some problems, so we will look into those problems. This is the visual overview of the chapter. And when we talk about investment appraisal, we're going to study risk-adjusted WACC, we're going to study APV. And along with that, we're going to study what are the problems related to risk-adjusted WACC. Okay. So now looking into the topic here, when we talk about alternatives to, in the introduction part, alternatives to using WACC, right? We have now established that WACC should only be used if the business risk and the capital structure are likely to stay constant, right? If they are likely to stay constant, use WACC. So when you use WACC in two cases, when the business risk and the financial risk both are likely to stay constant even after you start a new project. When that is the case, you can use the existing WACC, no problem, right? When that is the case, you can use an existing WACC, no problem with that. Okay. But if the business risk and the new project, differs from the entity's existing business risk, but if the business risk and the new project differs from the entity's existing business risk, but if the new business risk and the new project differs, so risk-adjusted WACC can be calculated. Okay, so what we will do, if the business risk and finance risk are not staying constant, right? If they are not staying constant, what we have to do is we have to take a risk-adjusted WACC. We will use a risk-adjusted WACC, right? We will use a risk-adjusted WACC. In these situations, we will use a risk-adjusted WACC, right? If there is no change. Second, if there is a change. Okay, if there is no change, we will use the WACC. If there is a change, we will use the risk-adjusted WACC. Okay, if there is no change, we will use the WACC. If there is a change, we will use a risk-adjusted WACC. Okay, so we use the topic of how do we use it. The tools we use is gearing and de-gearing. Two tools we use to do this. The tools are for gearing and de-gearing. Okay. First we will de-gear and then we will re-gear, right? The beta factors, right? We're recalculating the cost of equity to reflect the business risk of the new project. So what do? We recalculate the cost of equity. How is this process done? It is done through the process of gearing, de-gearing and re-gearing the beta, right? We will cover it in the later chapter, but this is just giving us an idea how this project is undertaken. Okay. So where a business risk differs from the company's existing risk, shareholders required a different return to compensate it because the risk has changed. So risk-adjusted WACC, what it does, it recalculates the cost of equity and it reflects the new level of risk while still using the company's own capital structure applies. What it does, it changes the cost of equity. Right? What we really do is that we change the cost of equity. Right? By de-gearing and re-gearing, what do? We change the cost of equity. What do we change? We change the KE. We change the cost of equity. Right? What do? We change the cost of equity. What do? We change the cost of equity. Okay. What do? We change the cost of equity. What is changed? Cost of equity is changed. Right. What is changed? Cost of equity is changed. We look into the process, how to go about it, and the cost of equity is changed. We re-gear and de-gear, and the cost of equity is changed. The capital structure is expected to change when the new project is undertaken. Okay, now if only the capital structure. The simplest way of incorporating the change in the capital structure is to recalculate the WACC using the new capital structure. This is appropriate when the change in capital structure is not significant. Alternatively, if the capital structure is changing significantly, then the APV should be used. Right? So if your capital structure, your financial risk, right? If your financial risk is not changing much, and in this case your financial risk is changing much. So in one case what is happening, your financial risk is not changing much, and the second case what is happening, your financial risk is changing much, right? So what do we do in either cases? In one case the financial risk is not changing much, and the other case the financial risk is changing much. Okay, in one case it's not changing much, in the other case it is changing much. Okay. So in one case, what happens? Your financial risk is not changing much. In the other case, what is happening? Your financial risk is changing much. Okay. It's not changing much in one case. It is changing much in the other case. Okay. What happens to your financial risk? It is changing much in the one case. It's not changing much in the other case. Okay. Your financial risk is changing much. Your financial risk is not changing much. Okay. So in either case, what do we do? Okay. So when your financial risk is not changing much, we can just calculate, we can just use new weightings. We can use new weights. But when it's changing much, we use APV. That's it. Theoretically, that is just a simplified. How do we go about it? Right? We can use the change back when the business risk and finance risk are not changing much. It's staying constant. But when it is changing, then we can business risk and finance risk is changing. New project differs from the existing business risk. Here they've kept the focus just on the business risk. If you look here, the focus here, they've kept it very specific to just the business risk. Here, only business risk. Okay, when the business risk on new project differs from the existing business risk. And next they've told about the capital structure, the financial risk is expected to change, right? Alternative to using WACC as a discount rate, we now establish that the existing WACC should only be used if the business risk and the financial risk are constant, then you can use your existing WACC. If the business risk is changing, then we have to use risk adjusted WACC. If the finance risk is changing and if it's changing slightly, we just use the new weights. If it's changing a lot, then we use the APV. Okay. So this is about this. बड़ा 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 है दे देख एक बार सीसीजे वाला देख जो कल मैं बनाया था तो उसके हिसाब से थोड़ा सिमिलर कर ले बड़ा कोई प्रॉब्लम नहीं है पर उसके हिसाब से सिमिलर देख ले ओके तीनों चीज क्वेश्चन रिक्वायरमेंट आंसर ओके तीनों चीज डाला है ना हाँ परफेक्ट एक ही जगह एक ही टैब में बस फिर नेक्स्ट क्वेश्चन कर ले डन okay so that is all about this that when do we use the APV when do we use new weights and when do we use risk adjusted WACC moving on now talking about the risk adjusted WACC there are certain process of calculating the risk adjusted WACC here so the business risk so we know it's mainly related to the business risk right when do we use if the business risk of the new project is different from the existing operation the company shareholders will expect a different return right when the business risk is not the same when the business risk is not the same. Then what do? We use a risk adjusted WACC. Hence, the appropriate WACC that should be used to discount the new project's cash flow is not the company's WACC but a risk adjusted WACC. So, what should we do in these situations when the change happens? We use a risk adjusted WACC. What do? We use a risk adjusted WACC, right? When there is a change in the business risk, when there is a change in the business risk because of the new project, what do? We use a risk adjusted WACC. Now, there are 6 steps on how do we calculate the risk adjusted WACC. Okay, so let's look into the six. Yeah, pretty much the same. Okay, so that is about this. Now moving on to the calculation here, we have 6 steps here. So firstly, we'll start, so find a suitable proxy equity beta. So just how we used to do the re-gear and de-gear, is find the equity beta of a suitable quoted company, right? The first step, what we do, we find an equity beta. We find an equity beta of a similar company. Then what we do, we adjust the available equity beta to convert it to asset beta. We take this equity beta that we calculated and we convert it to asset beta. After we have done that conversion, now in hand we have the asset beta. Okay. And what do? We readjust the asset beta that is left over. We readjust the asset beta that is there. After we have readjusted the asset beta, what do? We use this asset beta. Okay. We use this asset beta, readjust the asset beta to reflect the project risk. We use this asset beta and we convert it to equity beta again, right? How do we convert it? We take the capital structure that will be because of a new project. If there is a certain changes, we look into those changes and we will make this asset beta again to equal to equity beta. Once we have got the equity beta, we will use this equity beta in the CAPM. Okay, I will just write it in a shorter sense. Getting all over. Okay, so first what do? First what do? We find an equity beta. Next what do? We convert the equity beta to asset beta. Then what we do? We again take the asset beta, again convert it to equity beta. Okay, and then we use the equity beta in the CAPM formula and we find the KE. Okay, we find the KE using the CAPM, we use the KE. Using the KE, we find the WACC again. What do? We take the CAPM and we calculate the KE. We use the KE and we calculate the WACC. And then once we have the WACC, we discount using the WACC. New project cash flows. That's it. 6 step process. Okay. First step, calculate the equity beta. Second, from the equity beta, convert it to asset beta. Asset beta again converted to equity beta. Use that equity beta in CAPM and find the KE. Use this KE to find WACC and using the WACC, evaluate the project. Okay. So these are the 6 step process as written over here. That de-gear, then we re-gear, and we use the CAPM, get the KE, find the WACC, and use the WACC and evaluate the project. Okay. There we have some using the risk adjusted WACC. A risk adjusted WACC calculated above reflects the business risk of the project and the capital structure of the business, so it is a wholly appropriate discount rate. That is, it is suitable. It is a suitable. It is suitable. Two other issues also need to be considered. Okay, well, there are two other issues that also need to be considered. Right? The method used to gear and de-gear beta is based on the assumption that debt is perpetual. This overhauls the tax benefit where the debt is finite. Okay, so what they're telling is this method assumes that the debt is perpetual, which overvalues the tax shield if debt is actually redeemable. Right? It's overvaluing the tax shield. The tax shield is overvalued. Tax shield is the tax savings you get because of the interest payments. Interest is a tax deductible expense. So the tax shield is overvalued. Second, issue costs are ignored. So these are the two problems here of this method. Issue costs are ignored and your tax shield is overvalued. Okay. It's a suitable method with two limitations. Okay. It's a suitable method, but it has two limitations. It's a suitable method with two limitations. That the issue cost is ignored and your tax shield is overvalued. Issue costs are ignored and tax shield is overvalued. Issue cost is ignored and tax shield is overvalued. So we look into TYU1 here. Okay, same steps we will apply here. Hot air balloon manufacturer whose debt equity ratio is 5:2. This is the debt equity ratio. The company is considering a waterbed manufacturing project, BCO, to finance the project to maintain its existing capital structure. ESCO is a waterbed company. It has an equity beta of 1.59. So this is the step one. Find an equity beta of a suitable proxy company. So we have found the equity beta. So this is our step one. So we have found the equity beta of a suitable proxy company. Next, what do we de-gear it and convert it into asset beta, right? This is our step two, right? What we have done, we have taken asset beta and converted equity beta, and we have converted it to asset beta. Okay, this is our step two. We take the asset beta and we convert it into equity beta. Okay, first is we take the equity beta. Second is we take the asset beta and convert it to equity beta and convert it to asset beta. That is a step two. Step three, we re-gear the asset beta, but I'm just showing you the outline. Step three is we re-gear the asset beta. Okay, so we have taken this asset beta, as we can see 1.18, we have re-geared it. And again, we have equity beta. And once we have equity beta, we do the next step. And we apply this in the CAPM formula. And we calculate the cost of equity. Right, we calculate the cost of equity. Once we have the cost of equity, we utilize that and we calculate the WACC. Once we have the WACC, we discount the project cash flows using that WACC. Okay, this is the high level, all the 5 steps here. Okay, these are the 5 steps here for us. Step 1, we have the equity beta. Sorry, step 1, we take the equity beta of a appropriate proxy company. Step 2, once we have got that, we convert that equity beta into asset beta. Step 2, once we have got the asset beta, we convert that asset beta into again equity beta. But here we take the capital structure of the new project or the company after the project. And then we use that, calculate the KE, use the KE, calculate the WACC, use the WACC and discount. Okay, so now we will connect it to the question here. We've got a good revision of the process now. First thing, so we have the equity beta over here. It's given in the question. This is for information for us. Step 1. We have an equity beta. Okay, we have an equity beta of a good proxy company. Equity beta is there. Now what we do, we de-gear it and find the asset beta. So this is the process of de-gearing, right? What we have done is we have de-geared it and we have got the asset beta from the equity beta. This is the standard formula that asset beta is equity beta, which we have into the value of equity, right? Into the value of equity, right? So correctly, the value of equity and debt is given in this ratio here. The value of equity is 2. The value of equity is 2 plus value of debt is 1. 1 minus tax rate is also given in the question here. Okay, so we have solved for this, that BA, which is your asset beta, is equal to equity beta into the value of equity divided by value of equity plus value of debt 1 minus T. So we have the value of equity into the value of, the equity beta into the value of equity divided by the value of equity plus the value of debt into the tax. So what we have done is we have de-geared it. So once we de-gear it, we get the asset beta over here. Yeah, we've got the asset beta. Once we've got the asset beta, we've re-geared it using the same formula. This time we are solving for BE and we are using the capital structure of the current company who's undertaking this project. So we have done that and we found the new equity beta. Okay, we have all the raw materials for that. Next, we have applied it in the CAPM formula. Risk-free rate that I have given in the question 11%. Beta now the new one 1.51. Then the average stock market is 16% minus the risk-free rate of again 11%. We do that and we get 18 KE. Once we've got the KE, we find the cost of debt as well. Cost of debt they have given over here The yield on the VSCO's debt, which is assumed to be risk-free, is 11%. Equity is this. Average return on the stock market is 16%. Okay. So once we calculate this yield I told you is always pre-tax. We had studied yesterday, yield is always pre-tax. So to make it cost of debt, we make it post-tax. We've taken the yield and we made it post-tax. So we got the post-tax. So we have the cost of equity over here and we have the cost of debt. You see, this is the cost of equity. This is the cost of debt. Then we have multiplied with the weights. Then what we have done, we multiplied it with the weights to find the WACC. 5 by 7 is the weight here, 2 by 7 is the weight here because the ratio is 5:2. Right? So we got the WACC and this WACC will be used to calculate our, this WACC will be used to discount our cash flows. This WACC will be used to discount our cash flows. This WACC will be used to discount our cash flows. This is the 5-step process. Okay, this is the 5-step process. How we will be able to, a 6-step process that we will discount. The 6th step is not done over here. We're using the WACC to discount the cash flows. Otherwise, the 5 steps we have understood here. Okay. And we've looked into the limitations as well. The de-gearing and re-gearing procedure is a product of the theory. To use these equations, debt must be perpetual and risk-free. So here we are assuming it to be perpetual, and this is what is creating the first issue. If it is not perpetual, to ignore it for a shorter period will overvalue the tax shield. So you see, it is overvaluing our tax shield. This is the first issue here, first limitation. The value VE plus VD used in WACC equation would represent the market value of debt and equity of the project has been adopted. The equity value should include the NPV of the project. By using the ratio of the company before the project, we have assumed that the project has a zero NPV. This is unlikely to be the case. If the project has a positive NPV, the calculation will assume that the borrowing is proportional to the present value of the future cash flow rather than the initial value of the asset. Here, they have just discussed the same point in detail. If there are two things that is happening. First thing is, again, our tax shield is overvalued. Second, along with the issue cost being ignored, when we calculate the WACC, in the denominator, we have this formula, VE plus VD. This is used in the WACC equation. As we can see, we had just done the WACC equation over here, right? VE plus VD. Where is it? Yeah, you see, even in the WACC equation, it is used. Even in the gearing, de-gearing, it is used. VE plus VD. You can see here. WACC equation, which represents the market value after the project has been adopted, right? This is after. Okay, so even here, when we use, it is the after the project has been, so the V plus VD that we are using. Okay, the VE plus VD in the WACC equation. Again, in the WACC equation, how did we get the 7, which is VE plus VD? This is after has been adopted. Okay, should represent the market value of debt and equity after the project has been adopted, i.e., it should also include the NPV of the project. That also should have been included. So these are some flaws. The NPV of the project that we are considering, that also should be included because we are finding this after the project has been accepted. Okay, but what, by using the ratio before the project, we have assumed that the project has zero NPV, right? Because, but we are still using 5:2. Right, which was even before we accepted the project also it was 5:2. Now also we are, it is 5:2. So we are essentially assuming that the NPV is zero. We are essentially assuming that the NPV is zero here. That's a big problem. We are essentially assuming that the NPV of the new project is zero, which might not be the case. Okay, so it overvalues the tax shields, it ignores the tax cost, issue cost. The first is overvaluing the tax shield. Next, we are ignoring the issue cost. The issue cost is ignored. Overvaluing the tax shield, issue cost is ignored. We are overvaluing the tax shield, right? The issue cost is ignored. Issue cost is ignored. We are overvaluing the tax shield, and we are using the market value of debt, market value of equity after. And when we are using it after, we should also use the NPV of the new project. But since we are using the old one only, we are assuming that the NPV of the new project is zero, which might not be the case. Which might not be the case. Right? Which might not be the case. So why assume that? Which might not be the case. So why assume that? That's about this. Okay, which might not be the case. So why assume that? That is all about the first part of risk-adjusted WACC. Okay, so we have finished with the risk-adjusted WACC, which is the first process. Now we are going to the APV. Okay, that was the end of risk-adjusted WACC, and now we are going to the APV. Okay, we looked into the visual overview, got a good understanding, broke down all the theoretical aspects, when to use what, and the risk adjusted WACC, all the 6 steps, did the first TYU, understood the limitation, looked into little detail on the limitations as well. That is all about our risk adjusted WACC.